Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
So, morning, Dodge. Let's begin with the FOMC meeting. They are expected to meet tomorrow and the day after. And the S&P 500, of course, is within sight of an all-time high. Several banks have issued warnings to investors that the Fed might limit gains. Do you think investors are underestimating the Fed's response to improve financial conditions?
Well, good morning, Ibrahim. Investors are reacting in a very rational way given their needs. But I think the ultimate conclusion is not the correct one. You look at many investors, individuals, institutions, international, have essentially been forced to seek higher rates of income from dividend-paying stocks. So early months of this year, new capital has been pouring into utilities, to REITs, to other high-yielding stocks, while giving little or no consideration to the elevated and the climbing price-earning ratios that the market is experiencing. And since many consistent dividend-paying stocks are found in large-cap segments, their gains have helped to push the Dow Jones and the S&P 500 to near all-time new highs. This is all the evidence that many investors have needed, particularly in the value investor area. And there is an assumption that we're in a new broad-based bull market now that soon will be underway, and that they have rather aggressively been buying many discounted stocks. But in effect, there is a dramatic difference between the risks associated with a new bull market that starts from dramatically undervalued levels and the risk implied currently by a Fed-initiated interruption of a very old bull market that is already at the highest price-earnings ratios that we've seen in a decade. So, yes, it makes sense to see what's happening in the market, but the conclusion that we're in a new bull market, I don't believe is justified.
So with this new bull market that we are currently experiencing, how does this tie with the value of the dollar? Do you think it's rising too fast?
Yes, I do. And the problem is multi-sided. It's not only the dollar, but it's what the dollar is being measured against. So given our U.S. level of debt, a case could be made that the dollar should be going down and decreasing in value, and therefore would be a very good investment short. But obviously that's not worked out. It's because the other three big economies of the world are in relatively worse condition and have chosen to defer the day of reckoning through continuing money printing and also central bank manipulation. You look at Japan, it would be a challenge for Kuroda to induce Japanese households to borrow more money and stimulate growth given their existing debt levels. You look at China. China companies have borrowed something like $1.5 trillion in external dollar markets, and the emerging market economies also have been borrowing owing to the cheap dollar interest rates. China and the European and the emerging markets are struggling against global deflation, and so they're trying to hedge their immense dollar exposures, a process which drives the greenback even higher. So it's not as much about what's happening with the U.S. dollar in the U.S., it's relative to what's happening in other economies, and there's not an impetus now for the dollar to weaken.
Now, with this in mind, we know that now government bond yields are hitting record lows. This may have spurred some fixed income and bond market specialist Bill Gross to say that negative yield will lead to a so-called supernova market implosion. Why do you think Bill Gross is saying things like this?
Well, I think he sees a real risk, and it's shared by many others abroad as well as here in the U.S. And he did a study. He indicated that he'd go back half a millennium. And yes, he may have done that. And yes, it is pretty bad. I do agree that the current situation with the world's debt market is unprecedented and dangerous. I'm not sure that the ultimate conclusion will be as disastrous as what Bill is saying. And I'm not sure that he is really believing that. He is trying to make a point, and the point needs to be considered and understood. We have a possibility of a worse than expected result but that doesn't mean it's necessarily going to happen, particularly if we wake up to this.
With this in mind, we have the credit spreads and stock prices stabilizing. How does this add up to the whole story?
Well, the credit spread is stabilizing now. It is enough short term, but there's going to have to be more done to work this thing out on the longer-term resolution basis. We're going to have to stop the money printing, et cetera. With regard to stocks, I think that, as you saw on Friday, there was a pullback across the world, including the U.S., based on the perception that our growth is not as much as originally contemplated. So I suspect that stocks are going to have to rebalance, and that it's going to be harder for stocks to go to a new high and to get through the resistance that we've been seeing at the prior highs.
Right, let's shift towards Asia now. We saw that Nikkei and Hang Seng are pulling back on their figures. This may be seen as a worry towards a slowdown in the global economic growth. Do you think the markets in Japan and Hong Kong will hold up this week?
I think that there is enough going on that there will be a delay or there will be a hesitation to make a commitment to the concern about slowing U.S. and global economic growth. Yes, it is perceived across the board, but we have several factors coming up. This Tuesday, after the market, the New York market closes, comes a decision for the global index provider MSCI on whether to add mainland China-listed stocks to its very influential emerging markets index. So that's going to be a big issue. On Wednesday, we have our Federal Reserve emerging from a two-day policy meeting. Though an interest rate increase here is virtually off the table, dovish and hawkish tones could still roil markets. And then ultimately, although we haven't discussed it yet tonight, the discouraging big market bets is the fact that on June 23rd, we have the vote on whether Britain will stay in the European Union. So it's a stutter step at this point, and it's not, yes, there is a perception that the world is slowing down and the U.S. is slowing down more than expected, but there are certain factors, certain news items that are coming in that will delay markets making a full commitment to that perception.
So you touched a little bit on the Brexit vote. There was a survey done by ORB, an independent newspaper. They found that 55% are in favor of a Brexit. This is up 4 points since the previous poll in April. About 45% wants to remain in the euro. Is this worrisome for the markets to actually observe?
Well, it's too close to call. And ultimately, the undecided voters are still the key to the ultimate vote. And in absolute terms, Abraham, it will take years. Once the vote comes through, it will take years for it to actually occur in fact. And during that, the years of the process it takes that we'll have to go through, there may be a change in the ultimate decision. So I don't think that the vote itself is going to be the ultimate conclusion, but I do think from a market point of view, it will drive short-term perceptions of the strength of the world economy, and that is really going to be very important. I think there will be a hold, yes, but right now, Abraham, it's too close to call. It's not certain that the Brexit will actually occur.
How do you think the British pound is going to hold up for the next week or so?
I think it'll be the word that I'm looking for is hold. I think that it will fluctuate based on the perception of whether Brexit is going to occur, but I think ultimately the final move will not occur until after the vote.
Right, thanks, Dodge. You have a good week ahead. That was Dodge Dorland, Chief Investment Officer at Landor Fuest Capital Managers. He's calling us in from New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.